Hey, this is Peter from ShadowTrader.net and the Weekly Options Room. And right now I'm contemplating a trade on Carvana. And I'm doing this live here on a Monday afternoon. It is currently 3:14 p.m. as you can see here, Eastern Time. And what I'm seeing here is a nice move up. And I'm assuming that we are going to get up to this 350 area in this shortened week. Remember that Thursday is a half day and Friday the markets are closed. There's only really tomorrow and Wednesday and half of Thursday to get up there. And it seems very plausible. Now, one of the things that I think about a lot is when stocks have already kind of moved out of a pattern, you really want a complex spread, I think, which is going to be a lot more forgiving rather than going with something less complex like a vertical. So when I see a pattern like this, and I know I'm targeting this area, my initial thought is to go with butterfly, unbalanced butterfly, or broken wing. And so a complex spread like that, depending on how much I want to spend and whether or not I want to take on any upside risk. So that's kind of also important to note. So knowing that this 350, if that's the case, knowing that this 350 then kind of has to be my mid strike, and understanding that, I may not say turn, $1 into 10. It may be more like $1 into $2. That's totally fine with me. But regardless, I'm going to be using that 350 strike as the short-term target. And so if I go into here and I look at what spreads are available to me, I can see that I have obviously a lot of different choices in the butterfly realm. So the first thing we can start with is this, which is an broken wing. And you notice that it's very cheap, really good risk reward, because it could be worth 10 bucks in here. But you've also got upside risk because I'm pushing this 360 strike out to 380. But for that, I'm only paying 86 cents, which isn't bad. But the way you want to measure to see if that's dangerous or not is you want to look at what would this spread here be if you had the same spread on with 335 as the mid strike. See how you're up here and you're at 336? So what if this happened like tomorrow? What could you do to give yourself a better idea of like, well, what would my spread trade for, right? Well, it's very simple. You just go down and say, see how this is 325, 335? And this spread here is 340, 350, 380. And see how there's 30 points in between here? So I can just go 325, 335 and change this to 365. And that gives me a good idea of what this spread would trade for if we were there tomorrow. And you can see that I would be getting out for a debit. So this is probably not a good idea. This tells me right away that, if this stock does tax on another 15 points tomorrow and it's at my mid strike, I'm probably going to lose money, right? Because it's going to cost me a small debit or even money to get out. And I'm paying 85 cents. So that's probably not a good idea. So let's move to a different type of spread. What if we try it as an unbalanced? And this is an unbalanced without any upside risk, where we could pay $1.35 and have no upside risk, right? But if it blows through, it's worth nothing. But interestingly enough, we still have $10 wide to make here for $1.30. Notice that this 55 caps off the risk because this is 10. And this is 5, so this is 1 times 10, right? And this is 2 times 5 risk also equals 10. So going all the way through, I wouldn't risk anything. So this isn't bad. This is a decent choice, maybe, is to pay $1.29 and have that. The only problem with this type of spread is that if you get there too quickly, you're not going to maximize in terms of expanding this $1.30. And we can test that theory out once again the same exact way, right? We can just... Let's say we just changed this to custom and we said, what if we had to buy back 3 and sell 2 right in here? And what if we were at 325, 335, right? And then we've moved this to 340 to make it exactly the same. What would that be? We'd get $1.92 credit if we went to the mid strike tomorrow. That's not bad, right? Because we noticed that we're paying $1.31. So even if we get there too fast, we're still going to get out for $1.92. That's not bad. And we're also taking advantage of the fact that we're selling a lot of 350s. But of course, in order to do that, we also have to buy 2 355s because that's the only way we can put on a 1-3 spread and not have any upside risk, because obviously the 1-3 spread can be very dangerous with upside risk. So that choice isn't bad, right? We know that if we would be there tomorrow, we would still make money. What about just a straight butterfly? What if we look at just a 340, 350, 360? That's a straight butterfly. That's $1.55. You're paying a little bit more, but this is going to act better if we're there. Remember, this thing is going to be $1.95, right? So we go back to custom when we change the strikes again, and we say 325, 335, 345 to give us an idea of what it would be tomorrow. And we change this to here, to a straight fly, and we see 255. So we know that if this goes there tomorrow, we'll probably get like 255 for our $1.61 investment, basically, all right? And so this is how you measure basically complex spreads according to, what the risk is. You basically just move up the chain, if you will, in the options chain, or down, or however you want to look at it, and you move the strike, or you move the spread rather, to where it would be at the money, which will tell you what would happen in the worst possible scenario. Because remember, when you have a complex spread, the worst possible scenario is not that the stock goes down and falls away. It's the fact that it runs through, right? If you leave yourself with upside risk, like in a broken wing, for instance, right? One of those examples I gave was a broken wing butterfly with the 340, 350, 380. This one up here, right? The one that's only trading for 84 cents. So you're getting it super cheap, but as we proved, you're going to lose money if you're there tomorrow. So that leaves us with a choice to make. Which one of these is the best choice? So obviously that's not the best choice. I don't think the straight butterfly is the best choice, because you're not really exploiting some of that premium up there, right? We want to try to get as much as we can for those 350s. So I'm kind of leaning towards that the unbalanced here, right, which would be the 340, 350, 355, is probably your best bet, because I like the low cost. And one of the things that you want to keep in mind when you're putting on like a spread like this is you want this cost to be as low as possible, because remember, if this goes south on you, and let's say that Carvana falls apart, right, you want to be left with, that's the beauty of like the complex spread, is you want to be left with as many different calls up here at different strikes that you can sell away. And what this spread does is, let's say the stock falls down. Well, I'm long 2 of these 355s that I can sell, and then just kind of leave myself with the 1-3 at the 340, 350. I can leave myself here, right? And as we get closer and closer to Friday afternoon, this structure of being 1-3, being 10 wide, it has less and less risk, because there's so much more premium coming out of these 350s, and eventually there won't be upside risk at all. So I'm going to lean towards that, and I'm going to do that trade. And I'm actually going to do this officially with my group. So I'm going to put on 25. I'll start there, and we'll see about $1.32. Let's just go $1.30 here. So far, nothing. So that's interesting. That gives us some market generating information, so to speak, that we can't actually get that at that price, right? That's not going to work at that price. So let's see. So obviously you can see how it's just sitting. We have to go a little bit higher. Oh, there we go. Okay, so we got it at $1.30. Nice. There we go. And I'm gonna do just a 2 lot on that. And this is a new trade. And that's it. And that is out to my group. There we go. Move this over just to show you how that works. Okay, and so now I'm in the spread, and I know where my profit's going to be, right up in here. And again, I've got a lot of different avenues to go down to either get out of it if the stock falls apart, or as I've already proven, if we get there real quickly tomorrow, I'll be able to flip this for a profit right away. Okay, so anyway, so that's a quick kind of primer on complex spreads, and also showing you what I do basically every day, trading live with my group and Weekly Options Room. And if you'd like to join us and be part of this team, you can hit the link down in the description below. Take care. Hey, this is Peter from ShadowTrader.net, and I just wanted to thank you for watching this video. If you enjoyed this content, please hit the like and subscribe buttons. And if you'd like to trade live with me every day in my weekly options advisory, then check out the link in the description below. I wish you good trading, and I'll see you in the room.